Stock markets aren't a secret club for Wall Street wizards, and you don't need a finance degree to get started. They're a practical, rules-based tool you can learn to use this week to grow your money with discipline, patience, and a simple plan you can actually execute, even if you're starting with only a few $100s. The stock market is a place where people buy shares, tiny pieces of real businesses. When a company shows steady sales, profits, and growth, its shares tend to rise in value over time. When it misses goals or hits bad news, they can fall, sometimes quickly. Your ownership lets you participate in profits and growth, not just watch from the sidelines, and you can benefit even if you don't pick the exact winners. There's risk, but there's a clear path to manage it. Prices swing with the business cycle, headlines, and even investor emotion, which can push prices beyond what fundamentals alone would justify. By diversifying across many companies and sticking to a long horizon, you reduce the impact of any single bad result. Start with a clear goal tied to a realistic timeline and a specific number you're aiming for. If retirement is decades away, you can tolerate more volatility because you're buying time. If you need money in 5 years, you'll want to protect capital and accept lower growth. Write your plan down and commit to reviewing it quarterly, not daily. Set a starting budget you won't touch for everyday expenses for at least 5 years, and only invest money you can afford to lose. Before you risk the market, build an emergency fund that covers 3 to 6 months of essential costs in a separate savings account you can access without penalties. This cushion keeps you from selling in a panic during a downturn. Open a brokerage account with low fees, simple tools, and reliable customer support. Look for commission-free trades on both stocks and ETFs, intuitive mobile access, and clear explanations of any fees involved. If you're completely new, start with a basic taxable account and add a retirement plan later as your knowledge and funds grow. Begin with broad exposure rather than chasing individual stock stories. A total market ETF or broad index fund gives you hundreds of companies in one purchase, aligning with a long-term plan and reducing stock-picking bias. You can add a smaller fund focused on dividends or bonds to dampen volatility and improve risk-adjusted returns over time. Example: you have $1,000 to start this week. Put $700 into a broad index ETF and $300 into a simple dividend or short-term bond fund, keeping costs low and diversification high. Set up automatic monthly contributions, like $50 or $100, so you steadily grow your stake without relying on perfect timing or memories of yesterday's moves. Learn to read a quote in seconds: current price, daily change, and your rough position value. Check the 52-week high and low to understand context. Then glance at trading volume to gauge interest and liquidity. Use this information to inform a plan, not to chase every swing or react to rumors. Common mistakes include chasing hot stocks, overreacting to daily moves, and ignoring fees or taxes. Don't borrow to invest or rely on tips. Stay away from hype and remember that compounding works best when you stay patient. Build a habit of following your plan for at least 6 to 12 months before you consider changes. Useful tools include a basic brokerage app, an earnings calendar, and a simple set of screens to compare funds by cost and diversification. Do a quick weekly check to confirm you're still on track, and a more thorough quarterly rebalance to maintain your target allocation. Keep notes on why you bought or sold each position so you can learn from your decisions. To recap, set clear goals, build a cash cushion, start with broad market exposure, automate, and stay disciplined through market noise. As you grow, you can add more nuanced positions and refine allocations, but always bring decisions back to your documented plan. If you found value in this beginner guide, like this video, subscribe for more practical, no-fluff lessons, and leave a comment with what you want to learn next.